Hello, is my voice audible? Is my voice audible? Okay. So we are going to wait for a few minutes. Let others join the class and then we're going to start with the class. Okay, so let's wait for 2 minutes. Today we are going to do a case study on Building Societies Association case study. Fine? Is it fine, Mohammed Ashad and Sandeep? Okay, fine. So let's wait for 2 minutes. Just 2 minutes. Okay, let's start. Fine. So can you see the document on the board? Everyone out there? Is it visible to you? Okay, fine. So Building Societies Association case study. Building societies date back to the late 19th century. Okay, the first known building society was set up in 1775. This was to this was to enable people to pool savings together and to build their own homes. However, once they had built their houses, this particular society closed. Okay. In the 1840s, societies began to accept savings from members who are not necessarily potential homeowners. It was then that the permanent societies that we have today were formed. In 1869, the Building Societies Association was set up to provide national representation for the industry. The BSA is the trade association for all the UK building societies. It now has 59 members and together they have assets worth rupees 350 billion pounds. A building society is a distinctive business form governed by Building Societies Act 1986. Building societies are mutual organizations. This means that its borrowers and savers have membership and are joint owners of the society. The building society receives deposits from savers and then uses the funds to make loan for its members for the house purchase. So did you got the idea of what building society is? What do they do? What do they do? Tell me. Sandeep, what do they do? Okay. Now, so what do they do? Tell me first of all. Okay, okay, fine. Exactly, exactly. Yeah. Now, until the 1980s, only building societies generally could offer loans for houses. From the early 1980s, banks quickly became competitors. Okay. Following the Building Societies Act 1986, societies were also free to demutualize to become banks. The members of each building society has to agree to this change. Several building societies offered windfall payments to members to persuade them, and some big names became banks. For example, Abbey National, Halifax, and Alliance and Leicester. Mortgages. Buying a house is usually the most costly purchase an individual ever makes. People buy a house or flat to get a permanent home and a stake in the property market. Very few first-time buyers have enough cash to buy a property, so they take a long-term secured loan called mortgage. Right? We just cannot have 1 crore rupees to buy a flat, right? So so that's why what we do, we may have some savings, but for the rest of the money which we need to buy a house or a flat, we take loan, right? Right, everyone? Yeah. Only Sandeep is the student in class. How about others? Kelvin, are you not able to follow me? Kelvin, are you there or not? Farooq, Mohammed Arshad, please let me know if you people are there or not. Okay, fine. Now, a mortgage has two elements: the amount of the original loan, the capital, and the interest which is charged on the loan. Right? A repayment mortgage means that each month's payments pay off the interest and a small part of the loan. Right? By the end of the loan period, the borrower will have paid off the entire loan. When an owner buys a house, he or she has a valuable asset. If the value of the house increases, this can give them a profit if they choose to sell the house. Loan typically lasts for 25 years and secured on the property. This means that if the buyers do not keep up the regular monthly payments, the bank or building society could take the property back to sell it to pay off the debt. Right? There are two main providers of mortgages: bank like Lloyds, TSP, the Halifax or Bradford and Bingley. These are public limited companies and are owned by the shareholders. Building societies like Nationwide and Britannia. This case study outlines different types of business organizations and their purpose. It highlights the similarities and differences between other types of business and building societies. So is this much clear to everyone? Please let me know in the chat box. How about others? How about others? Is it clear? Is this much clear? Okay, fine. Fakhruddin, is it clear? I don't know why these people are not responding. Anyway, let's not waste time. You can do one thing. You can read it from here till mortgage, and I'm going to scroll it down. Okay, not mortgage, but entire loan, indeed. No, no, no. Don't change it, please. Yeah, just read it on your own. Once you are done with this, just let me know. I'm going to take you to the next page. And after this, we are going to switch over to the second page of this, where they are going to mention types of organizations. We are going to learn about that. Are you done with it? Are you people done with it? Should I scroll it down? Okay. Take your time. No issue. Okay. Okay. Now read the remaining parts of this. Read the remaining parts of this, please. Yeah, good evening, Maria. How are you? Just read the remaining. Actually, we are doing a case study today. So I have already taught them this page and I've asked them to read it to get the better understanding of it. It's okay. It's okay. So Kelvin and Sandeep, are you done? I can understand. It's okay. Is everyone done with it? Should we move to the second part? Yeah, hi Sabit. Kelvin, are you done? Yeah, very good. Okay, let's move to the second part of it. Hi Sabit, how are you? Now, let's move to the second part of it. There are several different types of organization. The simplest way to start up a business is to be a sole trader. One person provides the funds, makes the decisions and keeps any profit. The owner is also the boss and controls the business. Okay. The main disadvantage is that the owner is also totally responsible for any debts and has unlimited liability for these debts. An alternative is to form a partnership. So the simplest way to start a business is a sole trader. Okay. And I'm good, Sabit. Okay. Fine. An alternative is to form a partnership. This involves 2 and 20 people combining their finances and expertise. They run the business with joint powers and responsibility. They make decisions and share profits according to the legal terms of the partnership. The advantages are that the responsibilities are shared and more capital can be released to invest in the business. The owners can specialize in their area of expertise, improving the efficiency of the business. The disadvantages are that partners can disagree on important decisions, and consulting all partners takes time. All partners have unlimited liability for debts, and so selecting a partner needs to be done carefully. Many partnerships break up because the partners cannot agree. So either you can be a sole trader. See, there are different types of organization through which you can start a business. Either you can be a sole trader, it has its own advantages and disadvantages, or you can get into partnership. Fine. Is this much clear? Okay. Okay. Now, can you write down two properties of being a sole trader, and two advantages and two disadvantages, and two advantages and disadvantages of entering into a partnership? Can you please write it down? Everyone needs to write that down based on this paragraph. Is it clear? Kelvin, Maria, Sabit, Fakhruddin, Sandeep, Valappan, Farooq, Mohammad Irshad. Yeah, please write it down in the chat box. Two advantages of being a sole trader and disadvantages too, and two advantages and disadvantages of getting into a partnership. Yeah. Okay. 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 How about others? Can I see your answer? Kelvin, Sandeep, Maria, please show me your answers. Just show me fast. Okay, fine. Fine. Now let's proceed ahead. Bigger companies. If a business expands, it needs more capital. Okay. The opportunities for profit grow, but so do the risks of failure. The solution to these challenges may be to form a company. A company enjoys a privileged status in law. It exists as a legal entity that can be own property and can be named in legal actions. It also enjoys the privileges of limited liability. This means that only the company's assets are at risk to settle debts, not the individuals employed by or the investors in the company. A private limited company involves a group between 2 and 50 people supplying capital, finances and sharing in the management of the organization. The capital is divided into shares. These represent units of ownership, okay, units. For example, £1 share that individuals in the company can hold. Shareholders elect directors to run the company according to their wishes. Shareholders hold voting powers in the company's decision-making process depending on the number of shares they hold, okay, and receive profits in the same proportion in the form of dividends. Some enterprises outgrow this format and need access to much wider sources of share capital. This may mean becoming a public limited company. Okay? So private limited company and public limited company. What is the difference? This involves offering shares to the general public and to financial institutions. Okay? Shareholders enjoy voting rights on a one share, one vote basis, so larger shareholders have more power. The directors employ professional managers to run the business. The company may retain profits or distribute it as dividend for each share held. The selling of shares in a private company needs the director's approval. Okay? The shares in a PLC, okay, that is public limited company, can be bought and sold on the stock exchange where their value will rise or fall according to the performance of the market. A mutual organization is organized differently to this. Is this much clear? What kind of types of organizations we can have? We can be a sole trader, we can have partnerships, we can have private limited companies, and we can have public limited companies. Fine? Is this much clear to everyone? Shall we proceed ahead? Okay. Yeah, so I would like you to read this once more. Okay. Okay. Now what you can do, you can have to read it from on your own to get the better understanding of this. Okay. So read it from there till depending on the and don't move the board. And once you are done till here, just let me know. I'm going to scroll it down. No, don't move it, please. Yeah. Go ahead and read it, please. Okay, are you done with it? Okay, read the remaining parts of this. Read the remaining parts of this, please. Okay, done? Fine. Now, let's proceed ahead to the next part of this. Okay. Benefits of mutual organizations. We're going to learn this. Okay. Yeah. A building society is a mutual organization. This means that instead of having shareholders, it has members who collectively own the business and are also its customers. The main examples of this type of organization in UK are cooperative societies, mutual insurance companies, and building societies. Okay, members have the right to vote for directors regardless of how much or how little money they have with the society. To compare the scale of mutual organizations, the assets of the UK top 5 building societies amounts to rupees 250 billion pounds. Lloyds PSB, a bank alone, has the assets of 350 billion pounds. Large businesses like banks may enjoy economies of scale. By having more customers and so lower unit costs, they might appear to outperform building societies in attracting customers. However, this is not the case. So why do people choose a building society over bank? That is the question. Every building society invests its profit back into the society business. Okay. So whatever profit these building societies are making, they're going to invest this back into the society business. Okay. Is it clear? Is this much clear? Unlike banks, mutual do not pay dividends. For example, Lloyds TSB pays out nearly 2 billion pounds each year in dividends to shareholders. This enables the building society to offer competitive rates of interest on both saving and mortgages. It sets the rate it pays savers at just less than the rate charged to borrowers. This margin gives the society a profit. Customers choose to do business with the building society because many find them more personal, approachable, and more trustworthy than banks. An independent survey during 2007 found significantly higher levels of saver and borrower satisfaction with the customer service in building societies. Borrowers often rely on advice about mortgages or financial services. Many banks have closed local branches or replaced personal counter service with call centers. The personal service gives customers a sense of value for money. Fine? Now, can you please read it from A till money on your own before we switch over to the next part? Yeah, please read it on your own, and once you are done, just let me know. We're going to switch over to the next part. Once you are done, just let me know. Okay, fine. Let's proceed ahead to the next part of this. Yeah, shareholder and stakeholder. Now, what is the difference? The shareholder in a PLC. What does PLC stands for here? I have told you about it. What is PLC? Public Limited Company, right, Sandeep? The share in PLC owns shares which pays dividends. Shareholders are able to vote on major company decisions. Shareholders may include customers, employees, other business and wider public. Stakeholder. A business stakeholder include anyone with an interest in the company and its activities. Okay, financial or otherwise banks set their strategy to maximize profit, to increase the share value and give shareholders the best dividend. They aim to achieve this by giving lower rates for savers and taking higher rates from borrowers. Customers, of course, would prefer high saving rates and low borrowing rates. This can mean a conflict of interest between bank shareholders and its customers. A building society's primary stakeholders are its members. Members collectively own the business and are entitled to information on the business and to vote on important issues, such as who is on the board of directors or whether to merge with another society. Members want the highest possible interest rates on their saving and lowest interest rates on their mortgages. Building society rates are carefully set for each type of customer account. Their level depends on the interest rates in the economy set by the Bank of England and the rates and terms offered by competitors. Because they run for their members, building societies also have a focus on corporate social responsibility, CSR, that is integral to their business. Most societies have strong regional identity and many are committed to assisting communities, initiatives and local. Is it clear who are shareholders and who are stakeholders, or where lies the difference? Okay. Now, can you please, yes, sure. See, shareholders, you know, okay. And when it comes to the stake, what does that mean? Like stakeholders, okay. See, stakeholders can affect or be affected by organization act. So, see, stakeholders are creditors, directors, employees, okay, government, owners, suppliers, unions, all these people. Okay, let's learn about it in detail. Like what exactly is a stakeholder? See, a person, a group or organization that has interest or concern in an organization would be a stakeholder. Okay. For example, I'm going to put some documents on the board for this. Okay. Wait for a while. See, Maria and others. A person, group or organization that has interest or concern in an organization. Stakeholders can affect or be affected by organization's actions, objectives and policies. Some examples of key stakeholders are creditors, directors, employee, government, owners, suppliers, unions and the communities from which business draws its resources. Not all stakeholders are equal. A company customers are entitled to fair trading practices, but they are not entitled to the same consideration as company employees. An example of negative impact on stakeholders is when a company needs to cut costs and plan a round of layoffs. Okay? This negatively affects the community of workers in the area and therefore local economy. Someone owning shares in a business such as Microsoft is positively affected. For example, when the company releases a new device and sees their profit and therefore stock price rise. So now you want to understand the difference between stakeholder and shareholder, right? Right, Maria? Like, where lies the difference? This is what you are asking, right? Okay, cool. Alright. I'm just going to put it here on the board. See, I'm going to explain it to you. Shareholders are stakeholders in a corporation. Okay, but stakeholders are not always. See, shareholders are stakeholders, but not always stakeholders are shareholders. Okay, and I'm going to put it here. Yep. As see, shareholders are stakeholders, but not always, it's shareholders are always stakeholders in a corporation. Keep in mind this thing, but stakeholders are not always shareholders. A shareholders own a part of the company through stock ownership. That means shareholder is going to have a share, while a stakeholder is interested in the performance of the company for reasons other than stock appreciation. Got my point, Maria? Stakeholders could be employees who without the company would not have jobs. Okay. Bondholders who would like a solid performance from the company and therefore a reduced risk of default. Customer who may rely on the companies to provide a particular good or service. Supplier. So shareholder is going to have a share, okay, ownership in the company. But stakeholder, they can be employees because they're getting job from there. They can be bondholders, they can be customers, they can be suppliers, okay. Although shareholders may be the largest stakeholders because shareholders are affected directly by a company's performance, it has become more commonplace for additional groups to be considered stakeholders too. Is it clear? Is it clear what is the difference between shareholder and stakeholder? Everyone out there? Okay. So can you read this page on your own from here till here? So that we can switch over to the next part of this. Once you are done, just let me know, please. Once you are done, just let me know, please. All right. Now, let's move ahead to the next part of it. Yes. Raising finance. Okay. As a PLC, bank raises parts of its long capital from selling shares. It rewards shareholders with dividends. Funds also come from savers who are not usually shareholders. As a mutual or building society's owners and customers members are the same, right? Savers provide the society long-term capital and its main source of funding for its mortgages services. In both cases, people depositing money as savings expect to be able to withdraw their money at short notice. Okay? Lending money against the security of a property is a long term. In order to meet with the withdrawals from saving accounts, there must be enough cash readily available. Building societies keep about 20% of all money they raise in cash or assets. They can easily sell so that they can repay any savers who need to withdraw their savings. So what they do, building societies, they keep 20% of all money they raise in cash or in assets they can easily sell so that they can repay any savers who need to withdraw their savings. Banks and building societies both raise money from wholesale money markets. This is where bank borrows and lends money between themselves. Building societies by law may borrow only up to 50% of their total funding from money markets. The average amount societies fund themselves from the money markets is around 30%. Banks are not constrained in the same way. For example, in 2007, the Northern Rock Bank has taken this ratio of borrowing to 75%. It faced collapse when the amount of credit available in the money markets dried up. Building societies keep the margin between saving and borrowing rates narrow. This allows them to compete for funds and continue to offer competitive rates to their members. Fine? Is it clear? Can you please read it on your own? Just read it on your own and then we're going to switch to the last page of this, that is the conclusion. Fine? Is it clear, everyone? Please read it on your own. Once you're done, just let me know, please. Is everyone done with it? Okay. Now let's do the conclusion of this. Okay. See, there are different types of organizations, right? From sole trader to PLC, that is private limited company. Each has a public limited company or private limited company. What does PLC stands for? Private or public? I am saying, Sandeep is saying public. I am saying private. Am I correct or am I wrong? I am saying public. I am saying private, not public. No, it's public only. Yeah, correct. Each has different levels of liability, risk and benefit. Banks are typical PLC organizations which source funds from shares and pay dividends to shareholders. Building societies are mutual organizations. Their members are both owners and customers. No, yeah. Okay, they compete with banks for their share of the market in savings and mortgages by highlighting their advantages as mutuals. There is a growing emphasis on the values of participation, personal service and locality in their brands. By not paying dividends to shareholders, they are able to provide more favorable interest rates and better terms for their members. To continue serving their members, building societies need to differentiate themselves from the high street banks. So now, this was the case study. Okay. Any questions on this case study? Okay. Now, what you people have to do, this is the last task for the day. You have to write in short what we have studied in this, just short summary of this case study. Okay. And then we are going to wind up with this class. And tomorrow we are going to cover what we were covering in the last class, that is the HR chapter from HR. Got it? You got my point? Just write the short summary for the thing. So just write it down. Okay. Yes. Yes, Shabit. What is the issue? Yeah, okay, fine. Okay. So we are done for today. Anyone, any questions? Do you have any questions? Anyone out there? Okay, okay. Any questions? Anyone out there? Please let me know in the chat box. Okay. Okay, thank you so much. Don't forget to fill the feedback form. Okay. And just put genuine comments there. Please be there tomorrow. We're going to continue with the same chapter we were doing yesterday under HR. That is a very important chapter. So please be there. Thank you so much. Take care. Bye.